Hello and welcome to the i3 podcast, Conversations with Institutional Investors. My name is Wouter Klijn and I'm the editorial director for the Investment Innovation Institute. For more information about our educational forums for institutional investors, please visit our website at www.i3-invest.com. That's the letter I and the number 3-invest.com. There, you can also subscribe to our complimentary newsletter i3 Insights, in which we discuss investment strategy and asset allocation questions with asset owners from around the world. Now, as you all know, we love our disclaimers in this industry, so here's ours. This recording is for educational purposes only. It does not constitute financial advice and is intended for institutional and wholesale investors only. Please enjoy the show. In this episode of the i3 podcast, Conversations with Institutional Investors, we speak with Mary Manning, Chief Investment Officer of the National Reconstruction Fund Corporation, a recently established 15 billion fund that has been set up to promote the manufacturing industry in Australia. We speak with Mary about the investment objectives and how to balance investing in innovative new technologies, such as the fund's investment in quantum diamonds, that is, industrial diamonds, not the fancy ones, with the risk profile of the fund. Mary reveals that they have over 900 applications for funding and are now looking for the best opportunities to invest, but also how to balance out the strategic asset allocation and avoid being exposed to too much equity holdings. We also discuss what sets the NRFC apart from other government funding and investment vehicles, such as the Clean Energy Financing Corporation and the Future Fund. Let's get started. Mary, welcome to the show.
Thank you so much for having me. It's a pleasure to be here.
No problem. So can you tell us about what actually the National Reconstruction Fund Corporation is? Because I understand it's created to help diversify and transform Australia's industry and economy. But it also has a return objective. You've been asked to take a commercial mindset to the organization. Is it a sovereign wealth fund, a government corporation, a subsidisation vehicle? What is it?
Great place to start. So the National Reconstruction Fund, or the NRF as we call it, is a sovereign fund. It was set up by the government about 18 months to 2 years ago. And the purpose is to diversify and transform the Australian economy. But maybe we can dig a little into what that means and why the NRF was set up. So the impetus for the National Reconstruction Fund and similar funds around the world, there are a number that have been established, was perhaps in the wake of some geopolitical events and then certainly in the wake of COVID, that governments realized that countries need to have some sovereign capabilities. So globalisation meant that, there was a lot of changes in the world, but it also meant that a lot of countries lost sovereign capabilities in certain areas. And one area where Australia's sovereign capability had been on the decline for some time was manufacturing. And so the Australian economy, as you're well aware, and your listeners will be well aware, lots of very impressive sectors in terms of mining and commodities and digging stuff up and, putting it on ships and sending it elsewhere, but not a lot of processing or value add or the manufacturing of those types of minerals. And similarly, a very vibrant services economy, but manufacturing in terms of actually making things in Australia had been on the decline. And, an economy that's structured this way carries certain risks. So COVID is probably the best example in terms of if there's a shock to the global economy and supply chains get disrupted, it's a very uncomfortable and vulnerable place for a country to not be able to make certain things. So I guess medical science is a great example. During the pandemic, Australia could manufacture hand sanitizers or certain vaccines or, let alone semiconductors and aspects like this. So part of the reason the NRF was set up was to make sure that we have these sovereign capabilities. And those are some of the companies that we're investing in. The next part that I'll add is those are some of the push factors about why the NRF was set up. But in terms of pull factors, as you may know, Australia has amazing research and innovation inside our universities and world-class startups and scale-ups. But a lot of these sort of companies or ideas that are in universities are not making the jump to commercialization. And then a lot of startups and scale-ups are actually going offshore because they can't find the financing in Australia. And so another aspect of the NRF is to make sure that these domestic companies or Australian-born companies or Australian-born ideas stay in Australia and benefit Australia and Australians going forward. So that's a brief intro to the NRF, and I'm sure we'll get into some more of the specific factors in the rest of the podcast.
Yeah. Now it's interesting that you mentioned that it sort of came out that COVID realization that a lot of manufacturing had disappeared overseas, and we've seen a lot of discussions around reshoring, friendshoring, but this seems to be more about supporting industry from the ground up.
Yes, that's exactly true. Supporting industry from the ground up and also helping to create new industries. So, one of the areas which is a focus for the National Reconstruction Fund is quantum. And you may be aware, but Australia is a global leader in quantum computing and in the supply chain that goes around quantum computing. It's a center for excellence in terms of people who work in the quantum industry. And so this is not sort of an industry that used to be great and then got offshore. This is an emerging industry, which is really exciting for Australia. And so that's part of our job also, is to make sure that those new industries emerge and become as important and as powerful as they can be.
Yeah, so we delve straight into some of the thematics in your portfolio there. Quantum computing, how did you identify that? Is that something that the team came up with as a thematic, or is that part of sort of a policy push into this sector? How does the opportunity get identified?
Maybe I will take a step back and just outline sort of the investable universe of the National Reconstruction Fund, and then I can go on to where quantum fits inside that. So the NRF has 7 priority sectors across the economy in which we can invest. And 7 is a lot. So we made up an acronym to remember the 7, and it spells red tram. So if you can't remember what the NRF does, just remember red tram. So the first R is renewables and low emissions technologies. The E is enabling capabilities. So this is kind of a broad brush term for a lot of aspects of technology. It's AI, machine learning, robotics, space, biotechnology, etc. The D is defense. The T is transport. The second R is resources. The A is agriculture, fisheries, and forestries, and the M is medical science. So if you add up all those 7 red tram sectors, it is a huge part of the economy. And one of the things that I did when I started was, back to your very first question about sort of sovereign capability and why the NRF was set up. If you look at those red tram sectors, some of them are sectors or industries where Australia already has a very strong competitive advantage globally. So resources, ag, renewables would definitely be in that category. And the idea is just to value add more, improve those industries and integrate them more into a manufacturing supply chain. The other ones, defense is probably the best example, and medical sciences also. These are areas where you have to have sovereign capability, regardless of whether you have a competitive advantage or not, because it's a vulnerability and a sovereign capability aspect. And then, transport is probably somewhere in between. So those are 7 priority sectors. It's very broad, and it covers the whole scope of the sovereign capabilities that Australia has and also needs. And then one of the things that I wanted to do when I first started was identify different subsectors within those red tram, because they're very broad. So what are the subsectors within each of those? So we actually identified over 50, which means the investable universe is enormous. And within enabling capabilities, which is the tech part, quantum was specifically listed in our act, the act that set up the NRF and called out of an area of focus. So of course we looked at it, that's what we're mandated to do, but certainly once the investment team started digging into the opportunities in quantum, it became obvious that this is a really exciting time for Australia, and it's an ability to build an ecosystem around an emerging technology in an area where Australia is already considered a global leader. So putting those kind of 2 things together, it's an area where we spent a lot of time analyzing and looking for good investments.
Yeah. So it's a broad universe. You also have a very sort of broad mandate in the sense that you need to improve the Australian economy. No pressure there. So how do you narrow that down to investment opportunities? And maybe you can put it a little bit in the context of you have a very clear investment objective, you have a target. What does that mean for sort of the risk profile that you target in the fund and the type of companies you can invest in?
Yes, we do have a commercial return. You mentioned this at the beginning, and it's really important to go back and highlight this. We have a benchmark. It's the Aussie government 5-year plus 2 to 3%. And, the investments that we make need to generate a commercial return. There's another very important part of our target return in the benchmark, which is that we must target this benchmark over the medium to long term. And one of the areas that we're finding already where the NRF can play a very important role is that a lot of the private funds and certainly the super fund industry, they by definition may be required to have shorter timeframes. So if you're a private fund and you've raised the fund and you need to deploy it by X date, you need to have generated returns by X date, or you're not going to be able to raise fund 2. And that makes sense. And certainly with your future, your super, the super funds have like performance hurdles, which are quite regular, and that is it can influence the way that you invest. And as you may know from my previous role, I spent a lot of my career doing equity investment, and your time horizon is super short. You have to give your investors like a monthly report, and you have annual performance, and you have your Bloomberg, and you wake up in the middle of the night and check your alpha every day. And so one of the great things about the NRF's mandate is we can take a longer term view, and that really opens up the universe in terms of some of the companies and the industries in which we can invest, because it's not a daily or a monthly or even a yearly target that we're aiming to. It's more that medium to long term. So in terms of identifying different opportunities, there's a couple of ways to look at it. I should mention that we can invest across debt and equity. So this is a really important aspect of what the NRF can do. Similar to my comment before in terms of there's the 7 priority sectors, and there's around 50 subsectors underneath that. Within debt and equity, there's 15 different sub-asset classes that we can invest in. So on the debt side, that goes for everything from senior secured to mezzanine to venture debt. And then on the equity side, everything from listed equities to private equity to series A, B. And then there's, if you add all of those up, it's about 15 different subsectors. So the combination of the subsectors and the sub-asset classes means that we have an absolutely huge mandate. So one of the first things I do, that show on Netflix, Everything Everywhere All at Once. One of the risks of having a very broad mandate is that you try to do everything everywhere all at once, and you end up doing nothing particularly well. So I wanted to make sure that we use this very broad mandate, but also we're focused on the right things so that we can actually get some things done, certainly in the early years of the NRF. So we do have a strategic asset allocation that allocates between debt, equity, and we can also do partnerships. So this is investing via managed funds, which in turn invest on our behalf. And then there are also certain allocations in terms of the different priority sectors. And within those 50 subsectors, we've identified 2 or 3 within the red tram of where we want to focus and where we're seeing the most opportunities. So that's what we're focused on right now, and anticipate that over time, those things may change, but it's important to have a map about where you're going and start in that direction. And then if you need to alter course as you go, then that's certainly understandable. But I felt very strongly when I started at the NRF about a year ago that we needed a map, and then we're following that map now.
Yeah, absolutely. So can you tell us a little bit about what that SAA look like? Is it more akin to, say, a balanced fund of a super fund? And I also believe that there is a capital commitment of about 15 billion for the fund. Does that sort of influence as well the way you look at the investments you make?
Yeah, so it's kind of a triangulation. I'm not going to give you the exact numbers in the SAA. That's confidential, but there are a few aspects of the NRF's mandate that were taken into account when this was developed. The first is that we need to have a diversified portfolio and invest across debt and equity, invest across those 7 priority sectors, and then also invest across Australia. So we can't just put everything in New South Wales or everything in like Perth-based companies. So those 3 aspects of diversification were taken into account in terms of what the allocations are. Secondly, we do have a medium to long-term time horizon, which I mentioned before. And so that means particularly in more of the early stage equity, you have the luxury of being able to invest in, say, Series A, B, or C, D, where you might not get that return for a few years. The other aspect of the NRF is that we do need to be a self-sustaining organization. So there needs to be some sort of interest income or dividend income or coupons from certain investments so that we are a self-sustaining organization. It's not like a private fund, which I was more familiar with before, where you have a management fee and then you have a performance fee, and your management fee is what's paying your working capital in the immediate term. The NRF obviously doesn't have a management fee, so we need to have some of those returns from the debt investments early on. So that's sort of how I circled it. And then the other thing is $15 billion is a lot of money. And I take that very, very seriously as a responsibility. And from a stewardship perspective, it is taxpayer money. And so sort of allocating out to the different sub-asset classes and then checking to make sure what that meant in terms of like our market share and whether that was reasonable in the context of the Australian economy. So I guess an extreme example would be if the SAA said, let's put 14 billion in Series AB. That would be like a multiple of the current market share. So obviously that's not going to work. So when I'm saying like triangulating, these were all the factors that went in and then coming out with an allocation that made sense across all those different characteristics.
If I look at the mandate where the fund is at a high level intended to stimulate local manufacturing and support the economy, there seems to be a little bit of a bend towards potentially more startup companies, smaller companies. But I think you can invest across the entire spectrum of startups to more mature businesses. How do you see that interaction between sort of those high level objectives and managing the risk profile of the fund? Does that limit the amount of like startups you can invest in?
This is a good question. So maybe I can just give you some flavor of what our current portfolio looks like, and then certainly what our pipeline looks like. So in our current portfolio, we've made 10 investments to date, and I'm really proud of these investments. I've been at the NRF for about a year, and our first investment was November. So in less than a year, we have deployed almost 600 million of capital across 10 investments. So I'm pleased with that momentum. But within that 10, the smallest is a $13 million early stage investment in a quantum company, and the largest is a $200 million convertible note in Arafura Rare Earths, which is a listed rare earths company. So even in those, like a small portfolio of 10 investments, you see a really big range in terms of the size and the maturity of the company in which we can invest. So for right now, there's certain investment deployment targets which we are aiming for, and it's important to have a diversified. This is a very, very simplistic point, but it's worth making. The best way to have a diversified portfolio is to have a diversified pipeline. So I spend a lot of time looking at the pipeline and working with the team to make sure that we have that diversified pipeline, and then if we can execute those deals, end up with a diversified portfolio. So in terms of your specific question about allocation to early stage, there's a couple of things that go into it. I guess one would certainly be the risk metric. The second would be what I mentioned before in terms of the NRF being a self-sustaining organization. And then the third would be just the capacity to deploy the 15 billion. So those are some of the factors that go into our investment decisions.
That quantum company that you mentioned, was that Quantum Brilliance?
Yes, we've made two quantum investments. Quantum Brilliance is the 13 million. And then we also made an investment into Quintessence Labs, or we call it Q Labs, which is another quantum business based in Canberra.
So that first one, I think they make, it's a foundry for quantum diamonds. And we're not talking jewelry here, we're talking about industrial applications. But what makes that an attractive investment?
Yes, you're right. This is not like Tiffany, the Tiffany of quantum. That's important to highlight. So part of it is within the quantum industry, there are companies and startups that are developing quantum computers, and then there are companies that are in the quantum supply chain. And as you may be aware, within the quantum computing, there are a number of different modalities, and it is unclear right now which modality is going to be the winner. There is some suggestion, and it's kind of a working thesis around the world, that it's a winner takes all, or certainly a winner takes most in the early stages of those quantum modalities. there's a few examples there. But when we look at individual quantum investments, and certainly quantum as a portfolio, you need to have some balance in there. Just saying, I think that this quantum modality is going to be the winner, and we're putting all of our quantum investment in that is a very, very risky strategy. So quite early on, we actually developed some thinking around a portfolio approach to quantum, and which modalities, plural, do we think could be potential winners, and let's try to have exposure to multiple modalities. And then let's have exposure within the quantum supply chain and some of those picks and shovels companies, which they can be successful regardless of what the outcome is in terms of the modality. So quantum billions, which is, as you say, sort of the hardware around the foundries and the diamond technology, and then Q Labs and other companies that have to do with cybersecurity or the software. Those are companies which are, or quantum sensing is another example. Those are also companies which we are very interested to invest in. So that's a top-down approach to quantum brilliance. Bottom up, we really liked the company's products and the fact that it is a foundry, so it's manufacturing something. Perhaps one of the areas that I have not focused on enough is that the point of the NRF is to manufacture things. So we liked that aspect of QB, really like the founders and the team. And they were fundraising, and it was a really good match with the NRF and our mandate.
The other quantum company, Q Labs or Quintessence Labs, it uses quantum communications. What is that, and why is that attractive in terms of the cybersecurity that they focus on?
Yeah, so Q Labs is a very interesting company, and again, really like the founder and certainly the products that they have and some of the customers that they have. Because one of the, to use some familiar phraseology, like the known unknowns about quantum, is that as we start using quantum computing more in society, there's a cybersecurity risk which is enormous. And it's kind of like a few steps away from where we are now. Like, people are just focused on what quantum computing can do, and then what that means for some of the the activities that go on in the economy. And then the third step is, okay, well, what does that mean for cybersecurity? And Q Labs is really a pioneer in terms of identifying some of those cybersecurity risks and then coming up with solutions. They have some very impressive companies around the world, and this is a Australian-born and Australian-based company that's in Canberra. So again, really good fit with the NRF's mandate.
Are there any sort of national securities aspects that you have to consider when you're looking at things like cybersecurity and cutting edge technology as quantum computing?
It's a very interesting question, and one that I was probably not prepared for. So do you, not the question I wasn't prepared for, but the linkages I was unprepared for. In terms of, if you remember in Red Tram, the D is defense. And the overlap between the tech part of the pipeline and the proposals that we get and the defense part is very, very strong. So we get a lot of dual use technologies that overlap between defense and enabling capabilities. And it's an opportunity for the NRF, because certainly having a sovereign investor where you have some of these thematics that are important to the government, and they have something to do with defense. It's quite helpful to have a sovereign investor on your cap table for a number of reasons. So that's an area where we are seeing quite decent deal flow.
So as a sort of a government vehicle, do you get to see insights in certain deals that maybe a commercial organization doesn't?
No, I don't think so. There's no there's no sort of inside track. I think one of the pieces of feedback that we've heard a lot from companies is that people are very patriotic, and they want, some of these founders, they want to stay in Australia. They want their kids to grow up here. They want the weather, and they want to go to the beach on the weekends. I'm sort of being facetious, but like, people really want, are very patriotic founders. However, sometimes the business opportunities are offshore and the funding is offshore. And so we do get a number of people who come to us who say, we would love for a sovereign investor to be on the cap table, because it means we can stay here. And it means that, as this company grows up, and if we need to list somewhere, at least there'll be some voice on the table that's saying, list on the ASX, not, do a flip up to US Topco and then list on NASDAQ. And Australia is losing a lot of really good companies, primarily to the US, but other jurisdictions as well, for those reasons. And so having a sovereign investor which is aligned with with their interests and has a medium to long-term outlook like the NRF can be helpful in keeping some of those companies onshore.
Yeah. So we've discussed the 7 priority areas, the red tram, so to speak, and each of those areas have their own financing target associated with it as well. And I had a look at some of them, and I think one of them is renewables and low emission technologies, which has a target of up to $3 billion, which is the largest of the 7 categories. And at the same time, I also saw that there are certain restrictions about investing into coal mining, into forestry assets, sort of the old economy type of assets. Is there a certain sustainability bent to the fund?
Yes, maybe I'll take there's a few questions in there. So yes, we do have targets that were in the Act and the Priority Sector Declaration for the different red trams, but you also may have noticed that they don't add up to 15 billion. So there was kind of like some high level thinking about these are levels of allocation, but they don't add up to 15. So the ultimate number is not going to be exactly aligned to those. And the other comment I'll make in that context is that it is surprising how much these sectors overlap with each other. So renewables and low emissions technologies overlap very, very closely with transport, because a lot of the deals that we get have to do with electrification or EVs or electrification of fleets, et cetera, and there's a transport angle to it. There's a whole other area of renewables and low emissions technologies which overlap with agriculture. This was another one similar to my comment about defense and enabling capabilities that I was a bit surprised about. But if you look at like sustainable aviation fuel, for example, one of the reasons Australia could have a competitive advantage in that going forward is because the available of feedstock, whether it's sugarcane or other agricultural products. So there's a really strong link between those two. So to be totally frank with you, it gets a bit complicated in terms of allocating individual deals in the red tram buckets, because some of them are in like 2 or even 3. That I think is actually evidence that the NRF's mandate is really important, because all of these same issues that the Australian economy is dealing with and the areas where we focus, they're all interconnected. And so if you can help solve problems in one area, there's second and third order effects that will help elsewhere in the economy. So to your second question, which was about the sustainability bent and sort of the old economy versus new economy, yes, we do have exclusions. There's not very many. So as you would well be aware, in some private sector sustainable funds or ESG funds, there's like a list of exclusions that are as long as there are. We basically have 3 or 4, and it's not an old economy or new economy dichotomy, because there's a lot of part of manufacturing which could be considered old economy, and then there's parts of like AI or quantum which are very strongly new economy. But one of the things that we found is that it's not really an old new dichotomy. It's just like, what are these companies doing, and are they forward facing? So it's my understanding that those exclusions are more so that it wasn't contradicting the investments we'd be making in renewables and low emissions technologies. So to be investing in renewables and then be also financing a coal-fired power plant, or you're working against each other in the portfolio. So that's one of the reasons why there's exclusions. The other aspect to mention from a sustainability perspective, but also in terms of some of the rationale for setting up the NRF and what we are mandated to do. So we have all the sort of financial metrics, what we have to do. And then there's a section in the Act called Section 17, which talks about other factors that we have to have regards to in our investment approach. And so very creatively, we call them the Section 17 factors, or the have regards to factors. And these are things like emissions reduction, circular economy, job creation, national security, crowding in private finance, regional development. They are more like non-financial aspects that we look at in our investment process. And 2 of those, the emissions reduction and circular economy principles, are related to sustainability. So there is that sort of connection between what we're doing and sustainable investing.
Yeah, because I know that in your background, you worked as an equity investor at Alfinity, and I think Alfinity definitely had a bit of a sustainable angle to its approach to equity investing. So was that sort of part of an overlap with the fund, and was that part of the reason why you joined it?
Well, Yes, we can talk about the personal reasons why I joined the NRF. I think the first thing is it is a very, very exciting mandate. I spent most of my career in investing in equities, and we're all very aware of the concentration in listed equity markets anywhere in the world, whether it's the Mag 7 in the US or whether it's the Australian banks in Australia. And as a listed equity portfolio manager, like what you're doing on a day-to-day basis is kind of boiling down to a handful of stocks, which you may have been looking at for years and years. So from my own intellectual and sort of professional development, I wanted to do something that was much broader. And the NRF certainly fits that that characterization. So the ability to be a chief investment officer, that was very appealing to me from a professional perspective. And then the ability to invest across debt and equity. And I will take this opportunity to say I have an absolutely amazing team, because debt is not my background, and even very early stage VC investment is also not my background. And so I'm really pleased with the team that's in place, because we work very, very closely as a team to make sure that everybody brings their area of expertise to the table, and everybody also has a broad view in terms of sectors that we can invest in. So, and then also the NRF, it's not just that we have a benchmark and we have to beat the hurdle rate and then that box is ticked and we move on to the next thing. There are these more important factors about diversifying and transforming the Australian economy and creating jobs and regional development, national security. The ability to play a role in that, even a small role, is really, really appealing to me in terms of the attractiveness of the NRF and certainly my role there.
So the team that you lead, are they all pure investment background, or are there also backgrounds that are more related to sort of the bigger macro picture, sector expertise? What is sort of the background of your team?
When I started, there was very few people on the team. This is an important point to highlight, is that another reason why I wanted to join the NRF is that it was kind of like a startup, but it already had $15 billion, which is very rare, right? Usually, I've started a fund in my career. It was a fund within Ellerston Capital, but you start with like $100 million or less than that in some cases, and you're building the team and you're building the investment process and the strategy. Well, you have very little bit of money, and then the idea is once all those things are running, you go out and use it to raise more money. And the NRF was not that. We had already been mandated $15 billion, and then you're kind of building it from there. So when I started, there was these really important building blocks that needed to be put in place, and one was the team. So the way it's structured is not unlike an investment bank. We have a head of debt, who's Simon Beisel, and then we have a head of equity investments, who's Guy Rapert, and then we have a head of priority sectors, who is Andrew McPhillamy. And then underneath the debt and equity, there's sort of the asset class specialists who have extensive backgrounds in investing in those asset classes. And then under Andrew's priority sector investments team, there's the sector experts. And then we have a pool of associate directors and senior associates who can work across all deals. And so the idea is that when an investment proposal comes in, or when we're looking at an opportunity, you have a deal team that has asset class. So if it's a debt deal, you have a debt person. You have the person that has the priority area industry knowledge. And then you have people from the pool who are working on the modeling and the writing the paper. And then we also have sort of specialist expertise in terms of technical analysis, ESG, et cetera. And that's how the deal teams are put together. And that's how we've made 10 investments in a very small period of time. But it's working really well, because you get a good cross-pollination of ideas and hopefully come out with really good investment ideas that have had a full 360 look at the opportunity.
Are you still building out that investment team, or is it now well in place?
We are still building out. So a great problem to have is that we have had over 900 proposals. So the NRF, yeah, I know. And hats off to another colleague of mine, Frank Tonkin, who it's his job to handle a lot of the inquiries as they come in. We do have a web form, so we get a lot of proposals that come in that way. And then certainly the investment team has an origination strategy. Like, it's not just the deals that come to us, it's what kind of deals do we want to do, and let's go out and talk to our the broader community and our networks and bring in the kind of deals that we want to do. So a combination of the inbound and outbound is over 900 proposals. So you need a big team to be able
Yeah.
to filter through those and then to be able to execute on a timely basis the investments that we want to do. And that's one of my commitments to the private sector. One aspect of the NRF, which we haven't discussed, is that we are mandated to crowd in private sector capital. So what that means is that, say there's a $100 million debt deal, and one of the big four banks is going to do it. We can't just swoop in and say, nah, come with us instead of, the NRF will do it instead of one of the banks. If there's private sector capital that is going to do that deal, then they should do it. But say there is a deal where they're kind of struggling to get it off the ground, and if the NRF commits like a cornerstone, then everybody else will come in. Or, you're the first investor in a Series A, and if the NRF is there, then other people will commit to the Series A. That's the crowding in aspect of it. And so one of my commitments is that if we are going to be crowding in private capital, from the market, we need to be working on a time frame which is in line with private capital deals. We can't be taking twice or three times longer to get deals done. Otherwise, it's going to be difficult to partner with them. So the team is still growing because we have a lot of deals in the pipeline, and we have a lot of deals that need to be executed by the end of this financial year.
So how close do you get to the companies that you invest in terms of, do you go all the way to a private equity model where you take board positions, that you get really hands-on with the management, or do you keep at arm's length?
So as per the Act, we are not allowed to have control positions.
Okay.
So yeah, we can't have more than 51%, or there can't be aspects of our ownership or our investment that would indicate control. That said, as part of our due diligence, we have a very detailed investment process. That was, other than the team, that was the second major block that I needed to put in place, is like, what is the investment process here? We can't just, I said about everything everywhere all at once before. The other image that we use a lot on the team is throwing spaghetti on the wall and seeing what sticks. That is not our investment process. We have a very, very detailed investment process that goes through the initial screening, and then phase 1, phase 2, phase 3 due diligence. And so in order to process things quickly, we get to know the companies very well through phase 1, phase 2, phase 3. And then if and when we invest, we have they're called AMPs, asset management plans, which is our intention of how we're going to manage that asset once it's in the portfolio. And we work with companies to make sure that those AMPs are in place. But yeah, it's not control positions, and then we have seats on the board and are dictating to the companies which way they go.
Fair enough. And do you use external managers, or can you also take direct stakes into your investments?
Both is the short answer. So far of the investments that we've done, most of them have been direct, and that is certainly the majority of our intention for the investments. But in that strategic asset allocation we discussed earlier, there is an allocation to partnerships, and we've done 2 so far. The most recent is Brandon Capital, where we made $150 million allocation into their BB6 fund. And Brandon, as many of your listeners would know, is a global leader in medical science and venture capital investing, and we're really thrilled to have them as a partner. Because it helps us address a part of the market which is very specialized. Like, it's not a coincidence that Brandon is one of our first partnerships investment, because to really understand some of those early stage medical science deals, you need a lot of sector specific knowledge. And while we do have some of that in-house, it's really helpful to have a partner. And then there's other aspects of the partnership which are helpful in terms of their network, their research, their own sort of research capabilities. And so that's something that we're looking for in partnerships. We've also made an investment in RCF, resource capital funds. So those are 2 examples. But certainly as other opportunities become available with respect to like funding funds, that's something that we can look at.
So it's a bit of a combination. It's not like the future fund that until recently wasn't allowed to invest with external managers, I think. If we look at the objective of the fund, one of the things that struck me is there's some areas of overlap with the Clean Energy Finance Corporation. How do you sort of split out what is your area and what is their priority?
Thank you for asking, because there is some confusion about what the NRF does and what CEFC does. The first point to make is that there are a number of SIVs, that's what we're called, specialist investment vehicles, that are set up by the government. So CEFC is one, but NAIF and Export Finance Australia, Net Zero Economy Agency, ARENA, these are other ones. And then you have the Future Fund, which is not a SIV, but obviously has similar characteristics. And we are mandated to cooperate with these entities. And it is fantastic. I come from a background where it's more about competition than collaboration. And so I'd just like to call out that the CEFC has been very helpful to the NRF. They've been around for many years and have learned a lot of important lessons, and they've been very helpful as the NRF gets set up, and certainly sharing those lessons with us. So it's a very collaborative environment, and certainly because renewables and low emissions technologies are one of our priority sectors, there's a lot of areas for overlap there. But the main difference is that the CEFC, or one of the main differences, can invest in generation, and that renewables low emissions technologies for the NRF is not about generation. It's about the manufacturing that has to do with the renewables supply chain. So they're related, but we are not. A good example would be if someone's building a wind farm. We're not financing the wind farm. But if there's a company that wants to make a part that goes onto one of the wind turbines and they're manufacturing that in Australia, then that's certainly something that the NRF would look to do.
So there's a clear distinction there. So if you look forward, what are sort of your priorities for the next 18 to 24 months? I mean, you've got 900 proposals to look at. I'm sure that keeps you busy, but it's sort of a strategic level. What are you focused on?
It's a great question. So because we're just into a new financial year, I have done an outlook for certainly the next 12 months. And then there's a medium-term outlook as well. So the first thing is that we need to continue to deploy capital at scale and with speed. $15 billion is a lot of money to deploy between now and FY30. And so there's certain milestones that we need to meet within there. And I'm really pleased at the outcome from the last financial year, because we kind of went from a standing start. We had no investments at all and not really a team and not really a process to go from there to exceeding our target, which was $550 million of investment. I'm pleased about that. We need to really continue that momentum going into FY26. So that's the first thing. The second thing is to do some more debt deals. So we have done 10 investments, but really like 2 of them are partnerships and 8 of them are, or 7 or 8, depending on how you count, are equity investments. So we need to diversify that portfolio into to make sure that it's across all of the aspects of the asset classes, and then also diversify across the 7 priority sectors. Of the 900 proposals that we've received, some of them are clumped a little bit in the priority sectors, but I'm very set on having a diversified portfolio, so making sure that that's diversified. And then I think the other thing is, and why I'd just like to say thank you for having me on this podcast, is to make sure that people in the market know who the NRF is, and they know who I am and who the team is, and that we really develop these partnerships, whether we sometimes call them like capital P partnerships. Those are the funds in which we invest, but there's also small P partnerships, which are just people that we work with in the market to discuss deal flow and to discuss what's happening in the Australian economy and investment opportunities. So really just to get the NRF's name out there and to work with people in the financial ecosystem to make some great investments.
Yeah. Do you work with some of the super funds as well? There's obviously a lot of expertise in that sector here in Australia. Do you sort of catch up for peer conversations there?
Yes, it's an area where I would like to do a lot more collaboration. So to be honest, when I started, it was like drinking out of a fire hose, and not just for a short period of time, like months and months of drinking out of the fire hose. So, now that we have that momentum and we're moving forward, I would love to engage more with super funds. Certainly where there's areas of overlap between the debt and equity parts. And then I know there are certain, like whether it's renewables or different parts of super funds where they're focusing on those asset classes. And then I guess the other thing is just to listen to what the super funds are saying in terms of areas where they're seeing opportunity or areas where they're not seeing opportunity, and why that is. That could be really helpful feedback for the NRF and how we look at investments.
Yeah. And if we do a little bit of crystal ball gazing, we fast forward 10 years, you've deployed the money, it's working. What is sort of the measure of success that you're looking for in terms of the the objective to stimulate the economy and stimulate manufacturing in Australia? What does that look like?
So looking forward 10 years, that would count in the medium to long term, time frame that I talked about before. So I guess the first thing is we would have had to deploy the 15 billion. And ideally, that we would see returns from that, and that's being recycled back into investment. Secondly, if you look at the CEFC, which you brought up before, certainly they started and they were successful in their investment, so they got more money allocated to be able to fulfill their mandate. And that is also an important goal for the NRF, is to do such a good job that we continue there. And then I guess the third thing would be some of those, Section 17 or have regard to factors that we discussed, whether we can see evidence that our investments, have led to job creation, have led to commercialization of Australian research, that they've led to improvements in national security. There's some good projects we can point to with respect to regional development. These are some of the things. They don't happen overnight. So it's not like you make the investment announcement and you can measure it the next day, but certainly on that medium to long-term time frame, those are areas that we're focused on.
No, I think it's very interesting. You get involved in a lot of exciting sectors and see a lot of new technologies, but there's also a big responsibility on your shoulders of transforming an entire economy. So, Mary, thank you very much for your time. You sound plenty busy, so it was great having you on the podcast.
Thank you so much for having me. I look forward to staying in touch.
Thank you for listening to the i3 podcast. For more information, please visit our website at www.i3, that's the letter I, the number 3-invest.com. And don't forget to like, subscribe and review. Thank you very much.